Let's talk to Connor Campbell. He's a financial analyst at Spreadex. Very good morning to you, young Connor. Right, we've got 3 stocks reported this week. Let's kick off with the first one. Royce, a ghastly looking chart, if I may say so. The mnemonic RR price in 2018 down about 3%. This story is bribery, gaps, profits warnings, goodness knows what else. That doesn't look a good fill position to me.
No, it's not a good looking chart. However, if you do, before this point, before around November, it was doing pretty well. And I think it still was up like 27% over 2017. Obviously, that is in the context of a rather bad 2016. But overall, it did still do well before, pulling back quite sharply. I think the big news in 2018, in January, they announced a pretty substantial restructuring program. I think they were reducing its core units from 5 to 3. I think there'll be civil aerospace, defence and power systems. I think that's with the Naval Marine Department and the Nuclear Submarine Department becoming part of defence, which makes sense. I think they also said they were looking at, they were evaluating strategic options for their struggling commercial marine division. I think that helped. You can sort of see in mid-January it spikes above 925, and that's because I think people were excited that they were perhaps looking to offload the commercial marine division. Those gains didn't really stick though, and it's continued to trickle lower. It's bounced a bit since its sort of mid-February lows, but is pulling back towards them. In terms of Wednesday's full-year figures, the figures themselves I think are expected to be pretty good. I think revenue is expected to rise 6.5% to £14.7 billion. Underlying pre-tax profits is expected to be up, I think, 8% to £878 million. So those are 2 decent headline figures. However, you've also got, I think analysts are expecting the company to spend something between 300 million and 400 billion pounds over the next couple of years on sort of replacing and fixing I think it's the Trent 1000 engine. I think this issue was flagged up in 2016. It's found in one of Boeing, I think it's the 747 Dreamliner plane. I think it's something faulty with the propellers. That is going to need to be fixed. I think already they've set aside around 50 million pounds, but obviously 300 to 400 million is a rather significant increase on that. So any comment on that on Wednesday, I think is going to dictate direction. Also, I think really investors are going to see more detail on this restructuring plan, and has it started to bear any fruit yet? Have these changes started to have the effects Rolls-Royce want it to have? I think especially they're aiming for a £1 billion cash flow. If it can show signs that it's on the way to that, again, I think it can pull off these lows. From our clients' perspective, we've seen a lot of people now closing their previous sell positions around these sort of £8, £8.20 levels. And now starting to come in around those £8.20 levels. I think they're looking for, it's fallen quite sharply in the last, 3-4 months, but those figures heading into Wednesday are expected to be fairly decent. I think they're looking for it to bounce back towards perhaps 850 on the back of these figures.
Understood. Okay, so let's move on now to the restaurant group. They're down 22% in 2018.
Yeah.
Obviously, the restaurants are hitting the headlines.
Very bad business to be in at the moment. I think, the report in The Guardian was something like 3 out of every 10 restaurant groups in the country are operating at a loss, which isn't really good. We've seen Jamie Oliver's restaurant group, doing very poorly. You've also had negative updates from like Strada and Prezzo and places like that. All the restaurant groups, restaurant group, that's Chiquitos, Frankie and Benny's, Garfunkel's, any sort of like big garish restaurant you'd find in a retail park or on a high street. That sort of restaurant groups.
It strikes me these scenarios, you can go online, buy one, get one free.
Yeah, exactly. I think you've got, people haven't got the money at the moment. It's interesting. I think people are spending more on eating out and stuff, but it perhaps is on slightly better restaurants than it's sort of the grade above these restaurants. Right. And then if you're looking at a similar price, you then perhaps, why would you go to a Frankie and Benny's when you could, like you said, order in from somewhere like Domino's, which we'll look at in a second, which is cheaper and arguably no real difference in quality. I think you've got that.
I would disagree with that. But
you've got that sort of mid-range level eating experience that's perhaps struggling at the moment because it's people with a bit more money aren't going to go there. People that are struggling aren't going to go there because there's plenty of options below that. And you've got sort of that caught in the middle. In terms of its figures, I think back in January it said that full-year like-for-likes were down 3%, full-year total sales were down 1.8%. I think in terms of this week's full-year figures on Wednesday, adjusted pre-tax profits is expected to be down, I think, a whopping 26.5% to, I think, 57 million, which that's an ugly figure. I think revenue is expected to be down around 6% to, I think, £669 million. Both of them not very good. Obviously, in terms of what our clients are doing, there are a few buyers I think purely because it's down 20%, 22% on the year, and it was down 10% in 2017. So people perhaps fishing about for a bit more good news. And to be fair, Restaurant Group did say in January that they'd seen, I think, they'd been aggressively cutting prices, especially at places like Frankie and Benny's, and I think they'd seen some volumes-led improvement as the year went on. I think they're also looking to open 10 more pubs this year. That's up on 3 openings in 2017, because that's one of the better performing divisions, and open a few more restaurants in airports, because again, those divisions, I think, trying to alleviate the pain seen in retail parks and high streets and things like that. However, it's a big question mark over whether those sort of tidbits can cover for those pretty ugly headline figures. So even at these levels, we've seen clients sell around 230, 240.
Understood. Okay, well, let's wrap up with Domino's Pizza. I had that experience over Christmas time, and I thought it was bloody awful. They're down 10%.
Yeah, down 10% this year, which is, I'd say, slightly harsh on Domino's given the strength of its figures that it posted back in January, really. I think organic system sales, total organic system sales for the year I think for the year they're up 8.9%, and for the fourth quarter they're up 10.1%. So, an improvement in the fourth quarter. That sort of was across the board, really. I think UK like-for-likes for the full year are up 4.8%. In Ireland, they're up 11.8%. Now, internationally, international total sales were up 17.1%, up 23% in the fourth quarter. So that's decent figures across the board, really, if you look at especially in the UK, a 4.8% like-for-like growth in the current climate, in the current, people's wages being squeezed and stuff. Domino's still has a decent grip on sort of that delivery market. In terms of what is expected to post on Thursday, I think underlying pre-tax profits expected to be up 6% to £91 million. Which again, that's a decent enough rise, given that it's fallen 10% in the last few weeks. Obviously, I think it seems to be an issue of expectation. Like, Domino's fell quite sharply on those figures back in January because they weren't quite as good as the year previous. So that could be an issue as well if it slightly underperforms at all. I think there are investors out there willing to sort of abandon it at the moment. But from our clients' perspective, they're quite heavily buying around that £3.10 mark. I think because it's, a rise in underlying pre-tax profit in the food sector at the moment isn't anything to sniff at, and given how sharply it's fallen, even in the last week or so, I think there's room for it to climb back towards 3.15 at the very least.
So would you buy the shares or the pizza?
I'd eat Domino's. It's not my favourite kind of pizza, but I would, I'd swallow it down in a moment of crisis.
On that note, Connor, thank you very much indeed.